Hello there. Welcome to EBM N5. I was still working on a paper, question paper. This is a question paper of November 2018. So we are going to look at this question. And on that question paper, we are going to look at question 4. And this is the question that we have, that is question 4 here. At the beginning of the question, we are given the income statement of Orange Business Company. This is what we have, and then we are given that income statement. Then below that, we are given also the balance sheet of Orange Business. So you see that this is the balance sheet that we have there. We have fixed assets, current assets, the section of equity, long-term liabilities. Then we've got current liabilities. So this is what we have. So we are going to go to the first question to see what we have for that question paper. On the first question, we have this one, which is going to be our first question, 4.1. So 4.1 is going to be our first question. It reads, how well is the business how well is the business compensating the owner for the risk? So the risk that is being asked here is the risk of operating that business, the risk that the owner has taken of operating a business. Remember, when you're operating a business, it's either going to make a profit or make a loss. So the fact that you are not sure of what is going to happen, it's a risk that you are taking. So what is the compensation that the owner is going to get? That is the question. So there we are going to calculate the return on investment indicator. The return on investment indicator is the one that is going to tell us what the business compensation is going to be in terms of the owner. So the return on investment, we're going to put down the formula of calculating that return on investment, and then we can now calculate substituting on the figures that are required to be entered. So you see that this is our first question, which is 4.1. You can just put the solution there. We have got 4.1, and we are saying we want to put down the formula of return on investment. So this is the risk that we want to see. So on the formula of this indicator or ratio, we are going to say our net profit. The net profit that we have there, the net profit that we have there is becoming the numerator. It's becoming the numerator, and then we also have the average owner's equity will become our denominator. So if we are having equity of 2 different years, we can add the 2, then we divide by 2 to get the average year. But if you are only given one figure for equity as in the current year, we can just check that figure, and we regard it as the average owner's equity. So here we are saying average owner's equity. And then obviously now there you multiply. We are supposed to present it as a percentage. So it means there we are supposed to multiply by the answer that you are going to get there. You multiply by 100 over 1. So this is what we have. So we can just go there and try to see what do we have in terms of net profit. What do we have in terms of net profit? And remember this, the figures we are going to get it from that statement that we are given. So net profit, the net profit figure that we are going to take note of is the net profit before tax, which is 14,890. This is going to be our numerator. And then our denominator is saying average owner's equity, but we're just going to take this owner's equity since we are given one figure. But if we are given maybe the details of the previous year, we're going to add the equity for the previous year, then we add to the equity of the current year, which is this one, then we divide by 2. But since we are given one, we just take this, and this will be the average, which is 133,000. So we can just go there, substitute these ones. So here what we are saying is this net profit is net profit before tax. Net profit before tax. So very important to take note there. So here we are now saying our net profit that we found there, we found that is 14,890, and then we divided by the figure for owner's equity is 133,000. 133,000. This is what we have, and then if you divide this, the answer that you get, you multiply by 100 over 1 to get the percentage. So you do that there. Let's try to see. Let's try to calculate there. So you see that if you calculate this and then you round it off to one decimal place, it's going to be 11.2%. So this is what we have in terms of the return on investment. So this is the return on investment. So this tell us the risk or the compensation of the risk that the owner is getting. So this is what we have on the first part, which is 4.1. So we can go and see what we have in terms of 4.2. So on 4.2, the question reads, work out the short-term liquidity position of the business. Hence, we are going to use the current ratio. So the current ratio, we need to know the formula of calculating, of presenting this current ratio. On the formula, we are saying current assets as to current liabilities. So we are just going to the question and try to see what we have in terms of the total of current assets and total of current liabilities. Then we present it as a ratio. But when you present it, this side of current liabilities, you are supposed to leave it as 1. So it will be 1:2. Then it depends on the figure that we are having here for current assets. So what we are going to do is the figure that will be on the current asset side, we divide it both sides so that this side remains as 1. And then we see what figure we get the other side. So I will go there to notice what figures we have in terms of current assets and current liabilities. So if you come here, you see that the figure for our current assets, we are given it here is 40,500. This is for our current assets. Then for current liabilities, you go down here, you see that we've got 7,500 that we have for current liabilities. So it's going to be 40,500 as to 7,500. So this is going to be our 4.2. So we can just present it there, our 4.2. So for 4.2, we are saying this is the current ratio. This is the current ratio that we are calculating. And then this current ratio, we are saying is current assets as to current liabilities. So our current assets are according to the information that we are given is this one, which is 40,500. So we're going to say 40,500 as to our current liabilities is 7,500. Then obviously this side now we are saying the side for current liabilities, we are supposed to leave it as 1. So we are dividing the figure that we are having on the current liability side. So we are saying divided by 7,500. Then here we divide also by 7,500. So when you do that, obviously this side is going to remain as 1. Was 7,500 to 7,500, we are going to get a 1. So here obviously we have a 1. Then here now we say 7,500 into 40,500. Then we are going to get 5.4. So this is going to be your 5.4, and then your ratio now is now 5.4 as to 1. So this is what we have. Then we can go on to see what we have in terms of the next question. What we have in terms of the next question. Right, on 4.3, is saying, does the business have enough cash to pay its debts? Then we are given a hint that acid tests average debtors collection period. And then these are the two that we are supposed to calculate. We are supposed to calculate the acid test ratio, and then the average debtors collection period also needs to be calculated. So we are going to calculate that. But we are also given that take note that 80% of total sales is cash. This one is going to help us. This one is going to help us when now calculating the debtors collection period. Because on the debtors collection period, we also have the credit sales as our denominator on that formula. So we are going to say 0.8 times the total that we have for credit sales. So we can go there and try to calculate. We start with asset test ratio, then we go to average debtors collection period. So we go there and try to see. What we are going to do there, this is now our 4 points. This is now our 4.3. 4.3. There we're having our 4.3. So on our 4.3, we are going to start with the asset test. Asset test. So the formula for asset test, we are going to say current assets. Then we subtract stock. This is going to be the left-hand side. Then we say S2, our current liabilities. Our current liabilities will take it as a total figure, but on the current asset side, we are going to say the current assets total, then we subtract our stock. So we can just notice the figures that we have there in the question. For our current assets, remember, current assets, we are saying we have got 40,500. And then we subtract the figure for stock, check the figure for stock that we have there. The figure for stock, we are having it in the year again. Stock is 11,000. Stock is 11,000. So we are going to say 40,500 minus 11,000. This is going to be our left-hand side. Then our right-hand side, we've got current liabilities. We are going to check this figure as a whole, 7,500. So this is what we are going to do here. So if you come here now, we are saying our current assets, remember, we are having 40,000, 40,500. Then we subtract the figure for stock, which is 11,000. We have 11,000 here. And then I'll say as to current liabilities. Remember, the figure for current liabilities, we've got 7,500. So all the same, like what we did on the current ratio side, this side is going to remain as 1. We are going to leave it as 1. Then it becomes as 2. The figure that we get this side. So to do that now, let's start by subtracting 40,500 minus 11,000. There. And then we divide by the figure that we get there, divide by 7,500. So here we can just divide by 7,500, and answer that we get there, we divide by 7,500. So the issue is that if we divide here, obviously you are going to get a 1. So 1 here is 2, and then we see what we get here. 40,500 minus 11,000, then we divide by 7,500. We are going to get a 4.4. So this is our asset test ratio. Then next, there see on 4.3, we also need to present the average debtors collection period. The average debtors collection period. So we also have the average debtors collection. Collection period. So on the average debtors collection period, the formula that we are going to use is we are going to say average debtors over our credit sales. Then we multiply by 365 days in a year. So 365 is the figure that we use for days in a year. Then here we on average debtors what we are saying this at this point we are saying this average come into play when we are given information for the previous year. Let's say we are given the debtors figure for the previous year, we add to the debtors figure for this year, then we divide by 2, we average. But if we are not given information for the previous year, like in this case, we just take the figure that we have for this year. So in this case, for average debtors, what we are saying is we are going to take the figures that we are given there as our average, or as our debtors, and to represent the average debtors. So if you come here, we see that trade receivables there, we have got 25,000 here, 25,000. So it represents our average debtors. So it's going to be our debtors. So we are going to say here we have got 25,000. Then we divide by the credit sales now is the one that we were told that if you go to the question, we are given a hint there that 80% of total sales is cash. So it means take note that 80% of the sales 80% of the sales is cash. So what does it mean? If 80% is cash, so the credit now becomes the credit here, it becomes 100 minus 80. 100 minus 80 here, and then you get your 20%. So what it means is that 20% there represents our credit sales. So we are concerned about credit, so we're going to use 20% of the sales figure that we are given there to find the credits that we have there. So if you come here now, we can check the total sales that we are given in the question. We are given 15,000 as we are seeing. So what does it mean? There 15,000 is here. So we are told, we know that now 20% is what 20% is credit. Then we multiply by 15,000 so that we find the credit the credit sales. Then we calculate there. Let's try to calculate there. But we see what figure do we have there. So if you calculate there, we are going to get 3,000. So this is going to be our denominator for credit sales. So we go down to check what do we have there, and just substitute our 3,000 there. So here we are here. So we are going to put our 3,000 here. Then we multiply by 365 over 1, get the number of days. So if you multiply there, you are going to get 3041, and then it's 0.6 66. So it means here you cannot have a fraction of a day, so you can just present it as 3041 days. Right, so this is the answer that you are getting, but practically you cannot have this number of days as average data collection period, which means maybe there was an error or a mistake in the way that this question was set. But on the correct answer, according to the information that we are given, is giving us 3041 days. So this is what we have, and then we can move on to the next question. The next question is now 4.4. We can try to see what we have on 4.4. Right, we can go to 4.4 and try to see what we have. 4.4 is saying, was the risk weight wide for the owner of orange business judging from your calculations? So this question is asking us about the indicators or the ratios that we've calculated just above, if we can interpret them and see whether this is making any good returns to the owner who has invested in this business or not. So we are just going to analyze the ratios in terms of the current ratio, as test ratio, and see whether these ratios are giving us a true reflection of a good performance of the business. So if you go there, you'd see that we can go back to the answers that we calculated and try to see that one, which is 4.4. So we are now on 4.4. We can just analyze here. We've got an asset test ratio of 4.4, 4.4 is to 1, and then we've got a current ratio. Remember, the current ratio is here, is 5.4 is to 1. So you see that these ratios are too high. So it means that we've got too much of current assets that we are holding in the business and that are not bringing any profitable returns. So the current assets, we should not tie much of the money or a higher proportion of the money in the current assets. We should maybe convert these current assets into cash so that they make greater returns for the business. So this is a too high ratio. So obviously the response that we are going to give is that it's not giving a good return. So we are now on 4.4, so we can just present it as 4.4. We are saying no, because the answer is yes or no, so we are saying no. So the reasons now we can say, maybe now we start by the current ratio. We are saying the ratio of current, the ratio, the first one is current ratio. The ratio of current ratio is too high, which means cash is being tied in current assets. So this is what we have there, and then we can also have we also comment on the asset test there. So you can say asset test ratio. It is too high again, the asset test ratio, because it's 4.4 is to 1. Is 4.4 is to 1. So here we've got 4.4. 4.4 is to 1, which is too high, meaning they're keeping too much of liquid assets, because the asset test ratio measures the liquid assets that are there in the business as a ratio to current liabilities. Liquid meaning those current assets that can be easily be convertible into cash, e.g. debtors, we can easily convert them into cash. So they are keeping too much of liquid assets. So this is not a good position. Remember, a normal good current ratio, a normal good, let's start by current ratio. A normal good current ratio should be at least 2:1, at least 2:1. And this one we have it 5.4. This one we have it 5.4. We have at least 2:2. 2:1. So here, if we have 2:1, at least it's a good position. Then for current, for acid test ratio, a good position that we can have is at least 1.5:1, at least 1.5:1. So if it's 1.5:1, we regard it as a normal position of acid test ratio. So in this case, we've got 4.4. So it means we've got too much liquid assets that are being held there. So on the current ratio, also you have to also mention the current ratio, which is obviously we have is 5.4:1. So here you can just maybe in brackets it's 5.4:1. So this is what we have there. This is what we have there. Right. So this is what we have on 4.4. Then you can go on to 4.5. So let's try to see what we have on 4.5. Right. Let's try to see what we have on 4.5. Right. On 4.5, we are here. The question is saying at break-even point, the business total sales in brackets income equals the total expenses. The fresh produce shop in Bloemfontein. The fresh produce shop in Bloemfontein sells more than one product. And we are given additional information whereby we've got fixed cost 18,000, and then we've got weighted average gross profit percentage, which is 45%, and then the cost price per unit we are given it as 20 rand. Then on the first part is saying 4.5.1 break-even point in units for the fresh produce shop. This is 4.5.1. So on 4.5.1, we can just say this is 4.5.1. So break-even points in units are usually the formula that we use. We say fixed costs over selling price per unit. This will be per unit, and then we subtract the variable cost. Usually issues per unit again, and then the fixed cost will be the total fixed cost that we are given in the question. But if you look in the question that we have, we don't have the figure for selling price per unit, fixed cost per unit. So we can use an alternative method for calculating this break-even point in units by saying fixed cost over the cost per unit that we are given. So in this case now we can go to the information that we are given and try to see. You see that we have got a fixed cost of 18,000. Then the cost per unit is 20 rands. So here we are saying 18,000 divided by 20. This is in rands. Then the answer that we are going to get will be the number of units. And if you calculate that one, you're supposed to get 900 units. So this is what we have there. Then the next question is saying weighted. Sorry, the next question is asking us to calculate the break-even point in rands for the fresh produce shop. So this is the break-even point in the value of money now, not in units. So we can just try to see the formula again that we can use there. We can now on 4.4, 4.5.2, 4.5.2. So this is now the break-even point. Break-even point in value. So the formula that we are going to use there, we are going to say fixed cost divided by the gross profit, or you can just say the average weighted gross profit percentage. Average weighted gross profit percentage. So fixed cost we know is 18,000. And average gross profit percentage we are given there in the question. Let's just check there. What figure do we have? We have got 45% that we have there. So here it means our denominator is 45%, and 45% as a decimal becomes 0.45. So we can try to calculate there so that we see what figure to have. We are saying 18,000, then we divide by 0.45 there. Then the answer that we are going to get is 40,000 rands. Remember, it's the value. We are calculating the value. Remember, we are saying value. So it's supposed to be in rands. So we are saying it's 40,000 rands. Yeah, 40,000 rands. So this is what we have in terms of the break-even point in the value. Then we now go to the next question. It's in rands, so it's in value. Next question is 4.5.3. Break-even point in rands if the business wants to make a profit of 50,000. So we're given a level of profit that needs to be achieved, and we are asked the break-even point, but it's going to be in rands, which means it's in value again. So we can just present the formula again. First 4.5.3. Now we are on 4.5.3. We are now saying 4.5.3. So this is break-even point. Break-even points in rands given given a level of profit. Given a level of profit. So this is what we can just present it as it is, and then we maybe try to bring down the formula now. And now the formula that we use, the formula that we are supposed to use there, we are now saying fixed costs plus the profits, fixed costs plus the profit that we are given. Then we divide by the average weighted gross profit percentage, average weighted gross profit percentage there. Then we see what we get there, average weighted gross profit percentage. So in this case now, we are just saying it is equal to our fixed costs. Remember, our fixed costs, we can just check there. Our fixed costs that we are having, our fixed costs, we're having a fixed cost there of 18,000 is our fixed cost, and then the profit target is 50,000. So it's 18,000 plus 50,000 is our numerator. Then we divide by 0.45. Let's try to do that. Then we come here. We are now saying here, we are now saying 18,000 is our fixed cost. Then the profit target that we are given is 50,000. And then we divide by the average weighted gross profit percentage is 0.45. So we can just try to calculate that one and see what we get. So we are saying 18,000. Then we are adding our 50,000. When you add the two, 18 plus 50, you're going to get 68,000. Then we divide by 0.45. You divide by 0.45. Then we are going to get your, 151,111.1111. Is it go like that? Being indefinite there. So what we are saying is it's in rands. So we are going to put our rands there. And we are saying it's 151,000, and then we've got 111 here, and then the 0.11 are going like this, and this is our money. So we're going to round up to 2 decimal places. We round off to 2 decimal places. We come here, we've got 1, which is in the range 0 to 1. So 1 is not going to change. 0 to 4. Our 1, which is behind this one, is on the range 0 to 4. So it doesn't change this figure. It remains like this. It is. So our answer here becomes 151,101.11. That is now to 2 decimal places since it's money. So this is what we have on the break-even points in rands given a profit level. So this is what we have. Then we check. We can check if we have got another question that is beneath that. On 4.6, the question reads: express the tax amount as a percentage of net profit before tax. Tax amount as the percentage of net profit before tax, and we are given a formula that we are given there. The formula that we are given is tax amount. So we are now on 4.6. You can just present here as 4.6. So we are saying tax amount. Tax amount we divide it by net profit for tax, then we multiply by 100 over 1. So this is the formula as it is presented. So tax amount, I'll go and check tax amount and net profit for tax, the figures. Our tax amount is here, which is 1,250. And then our net profit before tax is this one, 14,890, which is our denominator. And then we just substitute. So here we are saying we are saying 1,250 is our tax amount. Then we divide by net profit before tax, which is 14,890. And then we multiply by 100 over 1. Let's try to calculate that one. Right, when you calculate that one, what you are going to get there, you are going to get 8.39%. So this is what we have in terms of 4.6. And then I think we've got the last one on that question. What is the gross profit amount from income statement above? Right, we can go and check the gross profit amount that we have. It's here, 6,937. As simple as that. You just take it as it is, 6,937. So it's 4.7. 4.7, and then 4.7, we are saying gross profit. Gross profit amount is 6,937. So as it is like this. So this marks the end of this question. Thank you for listening. Those who haven't subscribed, please subscribe and share. We are still coming with more videos as we prepare for exams. So let's stay tuned for more videos. As for today, I'm out.